Hello everyone, I am Tejas Thakur. Welcome to the third video of this 12 video series of our module Debt Demystified. This is being brought to you by ProStart, a video-based training initiative by Kotak Mutual Funds. In the earlier video, we learned about debt market instruments. In this video, we are going to talk about bonds. Now let us look at some type of bonds. Fixed rate bonds. The coupon rate here is fixed for the entire life, that is till the maturity of the bond. Most government bonds in India are issued as fixed rate bonds. The next is FRB or floating rate bonds. Unlike the regular bonds, these bonds have a variable coupon rate. It is set at pre-announced intervals, for example, like every 6 months or every 1 year. Some FRBs also carry the coupon, which will have a base rate plus a fixed spread to be decided by the way of auction mechanism. This spread will be fixed throughout the tenure of the bond. The rate of interest for a floating rate bond is linked to a benchmark rate. This spread will be fixed throughout the tenure of the bond. There is no certainty that the future stream of income while investing in a floating rate bond. The best time to buy a floating rate bond is when the rates are low and expected to rise. Coming up on number 3 position is capital index bonds. These are the bonds where the principal is linked to an accepted index of inflation with the view to protect the principal amount of the investors from inflation. These were first issued in December 1997, which matured in 2002. They were 5-year capital index bonds. Index-linked bonds are issued by the governments to help mitigate the impact of inflation. They pay a real yield plus accrued inflation. These bonds are beneficial to investors because they are less volatile than the normal bonds, and the risk involved is less because of the uncertainty being reduced here. At number 4 position, we have inflation index bonds or the IIBs. The IIB bonds wherein both the coupon flows and the principal amounts are protected against inflation. The inflation index used by the IIBs may be the WPI or the wholesale price index and the consumer price index or the CPI. Inflation can have a dampening effect on fixed income investments, reducing their purchasing power and cutting their real returns over a period of time. This happens even if the inflation rate is relatively low. If you have a portfolio that has returns of 9% and the inflation rate is 3%, then your real return is about 6%. Inflation linked bonds can help hedge against inflation risk because they increase in value during inflationary periods. An additional upside inflation linked bonds is that their returns do not correlate with those of stocks or other fixed income instruments. Coming up at number 5 is bonds with call or put options. Here the issuer can have the option to buy back, that is a call option, or the investor can have the option to sell the bond, that is a put option to the investor, or bonds may have put only or call only or both the options. A bond option is an option contract in which the underlying asset is a bond. Like all standard option contracts, an investor can make can take speculative positions through either the bond call or the bond put options. In general, all type of options, including bond options, are derivative products that allow investors to take a speculative bet on the direction of the underlying prices or to hedge certain asset risks within the portfolio. At number 6 position, we have special securities. Government of India issues special securities to entities like oil marketing companies, fertilizer companies, Food Corporation of India, etc., popularly known as oil bonds, fertilizer bonds, food bonds, etc. These are issued as a compensation in lieu of cash subsidies to such companies. They are usually long dated securities. They carry a marginally higher coupon as compared to the dated securities. The budget division of the Department of Economic Affairs, Ministry of Finance of the Government of India on 27th September 2019, that is last year, issued a notification stating that it is issuing 6 special securities, namely 6.55% non-transferable special GOI security 2029, 6.60% non-transferable special GOI security 2030, 6.60% non-transferable GOI security 2031, 6.65% non-transferable special security GOI 2032, 6.65 non-transferable GOI security 2033, and finally 6.70% non-transferable special GOI security 2034. The 7th one in our list is STRIPS. STRIPS is an acronym as it stands for Separate Trading of Registered Interest and Principal of Securities. So let us see how this works. STRIPS are securities created by the way of separating the cash flow associated with the regular GSEC, that is, each semi-annual coupon payment and the final principal payment to be received from the issuer into separate securities. They are essentially ZCBs or zero coupon bonds. That is, they are issued at a discount and redeemed at par. They are created out of existing securities only, unlike other securities. These are and now are not listed, and are not issued through auctions. The coupons are sold as separate investments. RBI issued guidelines for STRIPS in pursuance of an announcement made in the annual policy for 2008-2009. The next in our list is SGB or sovereign gold bonds. The price of the SGBs is related or linked to the commodity price of gold. SGBs are denominated in units of 1 gram of gold and multiples thereof. In SGBs, the minimum investment is 1 gram and the maximum limit per fiscal year is 4 kgs for individuals, 4 kgs for HUF, and 20 kgs for trust. Series 5 of the sovereign gold bonds, that is SGB scheme, for the year 2021 opened for subscription in August this year, that is 2020. The issue comes at a time when gold prices are trading at record heights. Prospective bidders who intended to subscribe to the scheme were allowed to bid for a minimum of 1 gram of gold at 5,334 rupees per gram. There was a discount of 50 rupees if the prospective investors bid online. The issue closed on August 7, 2020. SGBs are to be treated more as an asset diversification strategy than as an option to earn superior returns. They are a substitute for physical gold. The next one in our list is the 7.75% savings taxable bonds 2018. The Government of India issued 7.75% savings taxable bonds in 2018 with effect of 10th January 2018. Resident Indian and HUF can apply for this bond. These bonds will be issued at par for a minimum amount of 1,000 and in multiples thereof. There is no maximum limit for investment in these bonds. The interest on these bonds would be taxable under the Income Tax Act 1961. These bonds will be exempt from wealth tax under the Wealth Tax Act of 1957. The Government of India issued a notification that the 7.75% savings taxable bond 2018 shall cease for subscription with the effect from the close of the banking business hours on Thursday, 28th of May 2020. It's time to play on the front foot, but cautiously. As we move on the risk matrix for debt funds, the funds with the lowest risk are the liquid funds, while the funds with the highest risk are the long duration funds. It is time to notch up the risk appetite, but one at a time. I'm sure that the above information on bonds has been great learning for you. But with learning comes testing as well. So, welcome to the quiz time once again. So, here's your quiz time. Self-check questions as we've done in the earlier two modules. So, nobody's going to rate you here. You are going to rate yourself. So, the first question coming up for you. Name 5 types of bonds. I think this should be simple because we've learned a lot of them. So let's have the look at the answer. Fixed rate bonds, floating rate bonds, capital index bonds, inflation index bonds, and special securities. I hope that was easy. The next one coming up for you. When did the government issue 7.75% savings taxable bonds? The government of issue issued the bonds with effect of January 10, 2018. The last one for the day. Ready? Here it is. What is the limit of SGB for individuals, trust, and HUF? Remember, these are 3 different points, right? I hope you remember them. Let's have a look. Minimum is 1 gram. Maximum is 4 kgs for individuals, 4 kgs for HUF, and 20 kgs for trust. Thank you so much for listening to me so patiently on the bonds and different type of bonds. In the next video, we'll have a look at bond terminologies. Basically, all the terms and terminologies which are used when we discuss about bonds. Till then, take care and thank you once again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.